It's kind of crazy, honestly. It breaks every conventional rule of, how markets are supposed to react to a multi-billion-dollar loss.
Right.
But that is the actual reality of Intel's Q1 2026 earnings.
It feels completely contradictory, which is why we've gathered an absolute mountain of sources for this deep dive today.
We really had to dig into this one.
We did. We are looking at the official Q1 2026 press releases, the actual raw earnings call transcripts with Intel's CEO Lip Bhutan and CFO Dave Zinsner, plus a stack of financial news analysis.
And we're even digging into the unfiltered, highly technical investor sentiment from Reddit's AMD stock community.
Oh, yeah, which is always an interesting place to look. So the mission here is to figure out what is actually going on beneath the surface. We need to understand how a company violently shifts from being this safe, reliable dividend stock to a high-stakes, all-or-nothing AI and foundry growth play.
Yeah, and to make sense of that shift, we really have to separate the accounting reality from the operational reality.
Okay, lay that out for us.
Because that $3.1 billion GAAP operating loss, which works out to a loss of 73 cents per share, by the way, it's incredibly deceiving.
Deceiving how?
Well, when you look at their non-GAAP net income, the underlying business actually generated a profit of $1.5 billion.
Wait, hold on. Looking at those numbers, bridging a $3 billion loss and a $1.5 billion profit, I mean, the math only works if there is a massive write-down or like a one-time charge hiding on the balance sheet somewhere.
You're spot on. That's exactly it. The bridge connecting those two numbers is made entirely of paper.
Paper.
Yeah. Specifically, it's $4.07 billion in what they categorize as restructuring and other charges.
Oh, okay.
And the vast majority of that is a goodwill impairment charge related to Intel's Mobileye subsidiary.
Okay, let's translate that for a second, because goodwill is one of those accounting terms that sounds positive, right? Like, oh, we have goodwill.
Right. But it usually means trouble when it shows up on an earnings report.
Exactly. So when a company acquires another business, they usually pay a premium over the raw physical value of the assets. And that premium is the goodwill.
Yes. And accounting rules are very strict about that premium. If the long-term market value of that acquired business drops, you can't just, keep pretending it's worth what you paid for it.
You have to face the music.
Exactly. You have to write down that goodwill. You take a massive charge against your earnings to align your balance sheet with current market realities.
Which brings us to the real irony in the sources, I think.
Oh, but Mobileye.
Yeah, because Mobileye isn't actually failing. I was looking at their specific breakdown, and Mobileye had a genuinely strong quarter.
They really did.
They pulled in $102 million in operating profit on $628 million in revenue. I mean, they are making money.
Right. So the impairment is strictly about future projections. It largely reflects how the broader market is recalibrating the timeline and the valuation of autonomous driving technology over the next decade or so.
Got it. So it's not an immediate operational crisis for Mobileye.
No, not at all. There's no actual cash flying out the door because of this impairment. It just makes the official GAAP accounting look like a disaster zone.
So if I'm visualizing this, it's a bit like, okay, imagine a homeowner doing a massive, incredibly expensive kitchen renovation.
Ooh, I like this. Okay.
So the house is covered in dust, the bank accounts are temporarily drained to pay the contractors, and on paper, their personal balance sheet looks terrible right now.
Right, they look broke.
But during that exact same month, this homeowner gets a huge promotion and a massive raise at work. If you only look at the cost of the renovation, like the GAAP loss you think they're going under,
Yeah.
but their actual underlying earning power, the non-GAAP profit, is stronger than it has ever been.
That's a great way to look at it.
Yeah.
And sticking with that renovation analogy, we do have to acknowledge that tearing down the walls was a really painful process.
Oh, for sure.
Getting that underlying operational engine humming again, it didn't happen by accident. Intel had to make some brutal cuts to get there.
The layoffs.
Yeah, they eliminated nearly 25,000 jobs globally across late 2025 and early 2026.
Man, that is a staggering human cost. You don't cut 25,000 jobs without fundamentally reshaping how the company functions on a day-to-day basis.
No, you really don't. It is a harsh reality of streamlining a massive legacy corporation. But, financially speaking, that streamlining is what's driving the numbers we are seeing today.
Right.
The core operations generated $13.6 billion in revenue, which means they've actually beaten market expectations for the 6th consecutive quarter.
6 in a row. That consistent beat makes me wonder about the product mix, though. Like, where is that $13.6 billion actually coming from?
It's a good question.
Because for the last 3 years, the prevailing market narrative has been incredibly one-sided. We've been told over and over that GPUs, graphics processing units, specifically NVIDIA's, are the undisputed kings of the AI revolution.
Right, and that CPU's central processing units, which are Intel's bread and butter, are just legacy tech, old news.
Exactly. But that narrative is exactly what CEO Lip-Bu challenged on the earnings call.
He really went after it.
He did. The bulk of that revenue is coming from a place many thought was stagnating, which is Intel's data center and AI group, or DCAI.
Yeah, their revenues climbed 22% year over year to $5.1 billion.
Wow.
In fact, AI-driven businesses now represent 60% of Intel's total revenue. Pan's core thesis there is that the CPU is reasserting itself.
Okay, I have to push back a little on that, though.
Yeah.
Is the CPU actually reasserting itself, or is Intel just, aggressively rebranding its server chips to ride the whole AI hype cycle?
Well, it's a fair skepticism to have.
Yeah.
But to see why it's actually real, we have to look at how AI workloads are physically changing at the hardware level.
Okay, walk me through that.
Think back to a few years ago. The entire industry was focused on training massive foundational models. And training requires feeding trillions of data points into a system simultaneously.
Right.
That requires brute force, parallel processing, which is the exact architectural advantage of a GPU.
Right. It's like doing a million simple math problems all at the exact same time.
Exactly. But now, the industry is shifting from training into deployment. We are entering the era of inference and agentic physical AI.
Agentic AI.
Yeah, the AI isn't just learning anymore. It's being asked to make real-time decisions. It's retrieving specific files from a database. It's checking security permissions, orchestrating workflows.
Interacting with software APIs, all that stuff.
Right. And GPUs are actually quite inefficient at that kind of complex sequential logic.
Oh, really?
Yeah. CPUs are specifically built for it.
I see. So it's kind of like an orchestra.
Okay, let's hear it.
The GPU is this flashy, brilliant soloist who can play incredibly complex runs perfectly, but the CPU is the conductor. You literally cannot perform a complex symphony without the conductor standing at the podium, keeping the 100-piece ensemble organized, managing the sheet music, and telling the strings exactly when to come in.
That's spot on.
Yeah.
And without that conductor, the soloists are just sitting there wasting energy.
Makes sense.
The CPU serves as the orchestration layer and the critical control plane for the entire AI stack. You need it to manage the system memory, the security protocols, and the networking.
And the ultimate validation of this is right there in the transcripts, isn't it?
Oh, absolutely. NVIDIA, the company, building the world's best GPUs, just selected Intel's upcoming Xeon 6 processor as the host CPU for its next-generation DGX Rubin NVL8 AI systems.
Wow. So NVIDIA is essentially saying to the market, yes, we build the best soloists in the world, but our soloists need Intel's conductor to function in a real data center.
It's a massive symbiotic relationship.
Yeah.
And it goes beyond just the main processor. Intel also announced a multi-year collaboration with Google to co-develop custom infrastructure processing units, or IPUs.
Now, what exactly does an IPU do in this context?
Think of an IPU like a highly specialized bouncer for a server.
Bouncer.
Yeah, in a massive data center, managing the flow of network traffic and encrypting data takes a huge amount of computing power.
Right.
An IPU handles all of those infrastructure tasks, offloading them so the main CPU can dedicate 100% of its power to actually running the AI applications. It's all about maximizing efficiency at a massive scale.
Okay, so controlling the underlying architecture of AI is incredibly profitable. The demand for server CPUs is clearly back. But Intel's ambition goes way beyond just designing these chips, right?
Oh, way beyond. They want to physically manufacture them for the rest of the world.
Right. This is their grand IDM 2.0 vision.
Exactly. They want to be the premier Western foundry.
And building semiconductor fabrication plants, or fabs, requires a completely unfathomable amount of cash.
Just astronomical.
Where do they get tens of billions of dollars to build these things?
Well, by making one of the most painful strategic shifts in corporate history, They killed their dividend.
Which is shocking when you know Intel's history. I mean, for decades, Intel was the quintessential widow and orphan stock.
It really was.
It was the safe, reliable, blue-chip asset you kept in your retirement portfolio because it paid you a very consistent, very comfortable dividend just for holding on to it.
And the decline of that dividend is a perfect roadmap of their strategic pivot. Let's look at the numbers for a second. In 2022, they were paying a robust 36.5 cents per share every single quarter.
Nice.
Then the reality of the foundry cost hit, and in early 2023, they slashed it by 66%, down to 12.5 cents.
Ouch.
Yeah. By late 2024, they suspended it entirely. And today, in April 2026, the payout is exactly zero.
Zero. But doesn't taking a stock from a reliable income generator down to zero completely alienate their core investor base?
Oh, completely.
I mean, imagine a legacy automaker that has spent 50 years building reliable, best-selling gas cars. Their customers love them. Then one day, they just halt production of their bestseller entirely to sink every penny into experimental EV research.
Right.
It's a massive gamble. You are essentially setting fire to your present stability to buy a ticket to the future.
And it absolutely set fire to their old investor base. The sources note that income-focused ETFs and investors who relied on dividend reinvestment plans, they didn't just complain, they fled the stock entirely.
They just bailed.
Bailed. But that exit has fundamentally changed the profile of who actually owns Intel today.
Who are they?
Those conservative income investors were replaced by aggressive turnaround specialists and growth funds.
Ah, see.
These new investors, they do not care about a safe 3% yield. They are betting on massive, long-term share price appreciation.
And they are betting on what Intel is doing with that saved cash. Because a zero payout is the cornerstone of their smart capital strategy.
Exactly.
They are saving about $3 billion a year by not paying that dividend. So what exactly does $3 billion a year buy you in the semiconductor manufacturing space?
Honestly, it buys you a down payment on a fab.
Just a down payment.
Yeah, building a single modern semiconductor fabrication plant can cost $20 billion or more.
Good grief.
We're talking about facilities that require hyper-clean rooms, hundreds of times purer than a surgical operating theater, housing massive, extreme ultraviolet lithography machines from ASML that cost hundreds of millions of dollars apiece.
It's sci-fi level stuff.
It really is. Intel is funneling every cent into this IDM 2.0 foundry expansion across the US and Europe just to build these facilities.
And they are using that cash to lock down strategic control, right? I read they just used $7.7 billion in cash and took on $6.5 billion in debt to buy back the 49% minority stake in Fab 34 in Ireland.
Yes, they did. They clearly want full, unadulterated control of their advanced manufacturing assets.
Makes sense.
And we also have to factor in the massive injection of capital from the U.S. government.
Ah, right, the CPS Act.
Yeah, through the GPS Act and the Secure Enclave program, the government made an $8.9 billion passive investment for a 9.9% stake in the company.
Now, a 9.9% stake is huge, but it's important to clarify what passive means here.
Very important.
The sources explicitly note there are no board seats and no governance rights attached to this money. The government isn't trying to, run Intel.
No, not at all.
It's an injection of capital driven by the reality that having domestic semiconductor manufacturing is now viewed as a critical, top-tier national security priority.
Precisely. The sources are very clear on that being the motivation. So they have the capital.
Right.
They've cleared the balance sheet, they've aligned their AI architecture with the biggest players, and they've hoarded the cash to build these massive foundries.
Right. But that brings us to the ultimate reality check of this entire deep dive.
What's that?
Does anyone actually want to use these new factories?
Well, if we look at the Intel Foundry's segment revenue in the Q1 report, it looks fantastic. On a surface level, it's up 16% to $5.4 billion.
Okay, that sounds great.
But when you dig into the fine print, the external foundry revenue, meaning chips they manufactured for outside companies, rather than their own internal product divisions, was only a very modest $174 million.
Wait, I want to make sure I heard that right. Out of $5.4 billion in foundry revenue, only $174 million actually came from external customers.
That's right.
That means the vast majority of that revenue is just Intel's product team taking money out of one pocket and handing it to Intel's manufacturing team in the other pocket.
That is the reality of their current process nodes, unfortunately.
Oh.
The industry isn't rushing to use Intel's older manufacturing tech. The entire multi-billion-dollar IDM 2.0 strategy rests entirely on their upcoming next-generation 18A and 14A process nodes.
And we should probably explain what those nodes are because the terminology has shifted recently.
Good point.
We used to measure chips in nanometers, like a 5-nanometer or 3-nanometer chip, and a nanometer is a billionth of a meter.
Right.
But 18A and 14A refer to the angstrom era, and angstrom is a tenth of a nanometer. We are talking about engineering and printing circuits quite literally at the atomic scale.
The physics involved are mind-bending.
Truly.
And that extreme complexity is why getting to 14A is such a monumental, expensive challenge.
Which brings me back to playing devil's advocate here.
Go for it.
Are they counting their chickens before this atomic scale 14A node even hatches? It feels a bit like Intel is building the world's most expensive, high-tech airport with luxury terminals and massive runways.
But they haven't actually gotten a single major airline to sign a contract to land their planes there yet.
Exactly.
It was a massive risk.
Yeah.
But the reason the stock jumped $50 billion is that they just got a very, very prominent airline to publicly state their intention to land.
Oh.
Yeah, Intel announced they're joining the Terafab project as a strategic partner alongside SpaceX, XAI, and Tesla.
Wow. That is a heavyweight lineup.
It is. And it wasn't just a quiet press release either. During the Tesla earnings call, Elon Musk was asked directly about Intel's involvement.
What did he say?
Musk stated on the record that Tesla plans to use Intel's 14A process for their upcoming hardware. He explicitly called it state-of-the-art and said it was the right move for securing their core manufacturing technologies.
A public endorsement from Elon Musk regarding the manufacturing backbone for his AI and robotics ventures, I mean, that is a massive catalyst. A letter of intent like that goes a long way in validating the billions of dollars Intel is spending to build this metaphorical airport. If Tesla is confident enough to commit to 14A, it signals to the rest of the industry that Intel's atomic scale engineering is actually on track.
But as you know, in the semiconductor industry, a letter of intent is just paper until the silicon actually ships.
Very true.
Execution is everything. And to get a true sense of how the market is digesting the probability of that execution, the Reddit RAM destock community provides an incredibly fascinating window into investor psychology right now.
I always love looking at that specific community. It's a group of highly technical retail and institutional investors who are literally dedicated to tracking Intel's biggest rival.
Right.
So how are they reacting to this wild quarter?
Well, first, there was just sheer awe at the market mechanics of that $50 billion jump. They recognize that a move of that magnitude isn't driven by retail traders on their phones. That is massive institutional money repositioning itself.
Absolutely.
But beyond the hype of the Terafab announcement, they raise some deeply technical, very valid concerns about what Intel isn't saying.
Oh, interesting. What are they noticing that the broader market might be missing?
They noticed that during the Q&A portion of the earnings call, CEO Lip-Bu Tan repeatedly sidestepped very direct questions from analysts regarding the server roadmap.
Sidestepped how?
Analysts specifically wanted timelines for upcoming processor architectures, known as Coral Rapids and DMR.
And for context for you listening, Coral Rapids and DMR are the code names for Intel's next-generation data center processors. These are the chips that are supposed to keep this AI revenue momentum going over the next few years.
Right. And one highly upvoted comment on the forum noted that DMR was originally supposed to launch at the end of this year, but now Intel is flat out refusing to commit to a firm timeline.
So the highly technical crowd thinks Intel is hiding a delay.
They think Intel is terrified.
Terrorist.
Yeah, the community's theory is that Intel is so worried about having another product delay hurt their fragile new reputation, they've simply decided to stop giving public roadmaps altogether.
Wow.
Tan calls this new approach a mantra of under-promising and over-delivering. But the Reddit critics argue that right now, Intel isn't promising anything at all.
Which is a massive red flag for hardware developers who need to plan their server clusters years in advance. They need to know what's coming.
Exactly.
That is a really sharp observation from that subreddit. It perfectly captures the tension between Intel's long-term visionary goals and the market's short-term demand for transparency and, reliable hardware delivery.
But surprisingly, that same critical community expressed immense respect for Intel CFO Dave Zinsner.
Really?
Yeah, across the thread, users described him as a breath of fresh air. They specifically praised his transparency and his ability to clearly articulate the brutal financial realities of this turnaround.
Like clearly laying out the Mobileye impairment,
Yeah,
right?
exactly. It really highlights how critical, clear, honest communication is when you are asking the market to trust you with a multi-year, multi-billion-dollar pivot.
Absolutely. So let's bring all these puzzle pieces together onto the table.
Okay.
We have the messy kitchen renovation gap finances masking the underlying growth. We have the technological shift where the CPU is stepping up to become the conductor of the AI orchestra.
Right.
We have the complete elimination of a decades-old dividend to fund a $20 billion pop foundry dream. And we have massive external validation from the Tesla ecosystem.
It's a lot to take in.
It is. What does this all mean for our understanding of the tech landscape right now?
I think Intel's Q1 2026 is a masterclass in why you have to read past the headlines.
Yeah.
If you only look at that $3.1 billion gap loss, you would think you were watching the slow death of an American tech giant. But that number masked a highly profitable core business. The sacrifice of their sacred dividend fundamentally altered their corporate DNA, transforming them from a passive value stock into an all-or-nothing bid to become the Western world's premier semiconductor foundry.
Yeah.
And they are executing this massive pivot while successfully riding the wave of CPU reassertion, proving that even in a world obsessed with GPUs, the foundational orchestration of the CPU remains entirely indispensable.
It really makes you look at that $50 billion market cap jump in a new light, doesn't it?
It really does.
It wasn't an irrational glitch in the market. It was the market suddenly realizing that the painful renovations are almost done, the framework is solid, and the new house might actually be spectacular.
Repeat.
Right, might be. But looking at the sheer scale of this IDM 2.0 strategy leaves you with one final, much larger question to ponder.
Which is?
If Intel actually executes on this, if they succeed in scaling that atomic level 14A process node with massive partners like Tesla and SpaceX, and they successfully fill those giant fabs they're building across the US and Europe, does the center of gravity for global chip manufacturing slowly begin to shift away from TSMC in Taiwan?
Oh, wow.
Because if it does, that doesn't just change Intel's stock price. That fundamentally rewrites the geopolitical balance of power and technology for the next decade.
And given everything we've just unpacked today, that is a shift you should be paying very, very close attention to.